funds. So common question is, rather than setting up a portfolio of individual stocks and managing that myself and choosing them, could I not pay a fund manager to do it for me? So imagine this pile of post-it notes is a collection of stocks. Could I not just say, Tim, I'll hand you some money, you go out on my behalf, buy lots of stocks, put them in a fund, and hopefully you'll pick the right ones and you will do well for me. So a fund is just a way of collectively pooling lots and lots of investors' money together in one vehicle. So what is the point of a fund? Now, this is the advertising blurb, if you like. I'll give you the flip side of this coin. But fund managers would say, well, we offer lots of things to private investors, and all sorts of names out there, big houses running funds, an awful lot of choice out there. But they would claim to offer expertise, so you get the fund manager's knowledge and experience, diversification, picking these off one by one, so you don't have to worry about spreading risk. The fund will do that for you by buying what could be 100 or so stocks. Then there's no limit on the number potentially. Then there's less hassle. Give me your money. Well, a fund manager will say, own some units or shares. I'll come back to those in a moment. And you don't have to worry about having a diverse portfolio and lots of different corporate announcements coming in and dividends flying around all over the place. Just own my fund. And then finally, economies of scale. Because I'm not just asking you to invest, it could be thousands of investors investing. I can go out and buy big. Now, you don't have to necessarily take all those arguments at face value, but that is the kind of argument for a fund. An easy life, automatic diversification, and expertise. If you're not an emerging markets expert, a fund manager might be. Now, that leads me to how many types of fund are there? And this is actually quite important. So flipping my high-tech board over, there are 3 there. The unit trust, or in the US is called a mutual, near enough, the investment trust company, and the exchange traded fund. And these days, any of those can be either active or passive. So let's have a think about each one in turn. So unit trusts, first of all, the biggest type of fund around in the UK, if you like, the one you see advertised all over the tube in London on the side of buses and so on. What is that? That is basically a fund manager taking your money and unitizing it. And what does that mean? It means essentially you buy and sell units between you and the fund manager. The fund manager then takes the money that you've used to buy units, invests it in the market, builds up some net assets, if you like, and then every now and again will tell you how you're doing by giving you a unit price. And the point about a unit trust is that although potentially there are 2 different prices, there's the price of what the fund has bought in the market, all those shares the fund manager's gone out and bought, whether emerging markets, UK equities according to the mandate, and the price of the unit. And you'd expect the 2 to be connected. So you'd expect the valuation of these to be reflected in the valuation of those. And the unit trusts, that is the case. They're held quite close together. There's a valuation exercise done, say once a day, let's say, where the fund manager sits down, works out the value of these and works out the value of that using the 2 pieces of information. They're normally tied quite close together. Whereas number 2 here, the investment trust, what you're getting there is essentially you are buying shares in a company, the investment trust company, run by a fund manager, and it goes out and buys shares in other companies. But the company you're buying into is itself listed on the London Stock Exchange. So that's a slightly different structure. May have the same mandate. Could be the fund manager says, I'm an emerging market equity specialist, for example. So it may sound like a unit trust, but actually you're buying shares in a company. And one of the consequences of that, like any shares in any company, is that the net asset value of the investment trust company and the open market price of the shares you bought can vary. So you can get this happening. So you can have a situation where the assets held by the investment trust are trading at a premium, if you like, to the open market price of the investment trust of the London Stock Exchange, or the reverse, all right? Or put it another way, you get a discount to NAV or a premium to NAV. And that upsets some investors and excites others. They say, well, hang on a minute, if there's a chance to buy a portfolio at a discount, surely that could accelerate my returns if that discount closes. Maybe, but equally, some investors get a bit nervous about the fact that the net asset value of the portfolio and its market value, if you like, are two different numbers. But nonetheless, there it is. And then you've got the exchange traded fund. And that essentially is an exchange traded unit trust, if you want to see it that way. So an exchange traded fund is just basically quite often an algorithm, if it's run passively, that is set up to mirror the performance of something else. And that something else could be an index, like the FTSE 100, or in America, the S&P 500, or it could be a basket of stocks chosen specifically to meet a certain mandate, emerging market growth. But the point is, these days, all of these can be either active or passive. And essentially, the name does what it says on the tin. Is this a vehicle, one way or another, that looks to follow an active investment approach? So the obvious thing would be a human fund manager going out and tinkering with the portfolio they bought on your behalf, rebalancing it, getting different exposures, buying and selling different companies. Or is it purely passive? In which case it's set up to basically track the underlying index. So put it very simply, if the FTSE 100 rises 1%, you'd expect your share in the exchange traded fund to go up about 1%. It's never a perfect match because there's something called tracking error, but you'd expect broadly for that relationship to kind of hold. Now, you might be thinking this all sounds very exciting. So funds sound good. There's lots of choice, lots of different mandates, different structures I can choose from. Or you might be thinking it sounds quite confusing. All right, but what are the problems with funds? And if you've been reading the newspaper over the last few years, you'll have seen some of these problems manifest. One is a thing called style drift. So you might go into a fund thinking it does one thing, and actually over time, the fund manager starts to drift away from their original mandate, perhaps out of a bit of boredom, perhaps they're not making the returns they used to. So regulators have got to be on that, because basically the fund may not be doing what it claimed to do on the tin anymore. Secondly, gating. That's quite a serious one. That applies to unit trusts, the one at the top here only. What's happening there is a fund manager suddenly thinks, crikey, I've got a lot of people wanting to sell this fund. Word's got out, things are going wrong. So the fund manager then, basically, in order to be able to give sellers their money back, if you like, redeem units, they've got to dump some of these assets in the fund. And as they start dumping assets in the fund, getting rid of them in order to pay back people who want to get out of the fund, that can create a kind of stampede for the exit, if you like. And gating is the response. It's not a great response, but it's basically the fund manager shutting the door and saying, for the time being, you cannot buy or sell units in this fund. And that can be the beginning of the end. Not something that can happen with an investment trust or an ETF in the same way, but it can happen to a unit trust. And we've seen it happen with one or two high profile names recently. And then there are costs. You pay for all of these benefits, basically. And that's something to be wary of. Funds don't do what they do for free. So I always recommend anyone thinking of buying a fund gets under the bonnet to understand what the impact of fund charges on their returns will be, for example, because funds, to put it bluntly, have several ways of getting money out of you. There's the initial charge. They might waive that. There's the annual management charge, and that can be made up of quite a few things for running the portfolio on your behalf. And there may then be an exit charge in a few cases for getting out. So it's important to understand that. So that brings me back to, well, hang on a minute. If, for example, I'm worried about a fund getting gated, if I'm worried about style drift, if I'm not actually sure what the fund manager is going to do on my behalf, and I might want a bit more visibility over it, what's the alternative? Well, oddly enough, the alternative is what Rachel's been talking about. You could set up your own portfolio with, say, 30 stocks in it. There are capital asset pricing models that tell you, what the minimum number you need is, but let's say 30 stocks. And that may well give you the sorts of performance you get from a similar fund, except that you can see what's under the bonnet, you can see what the costs are going to be, and arguably you've got a bit more control, especially if you're doing it yourself or with the help of, say, an investment manager, over what's in there and what stays in there over time. So there's no right answer. Do I create my own portfolio? Do I just give the whole thing to a fund manager? Do I do a bit of both? There's no right answer. It depends on your preferences. But on that note, I will hand you back to Rachel.